I knew when I first began dividend investing, I had a lot of questions. So this video is going to be geared toward dividend investing newcomers, and I'm going to keep this video short and simple. I am going to be going over what a dividend is, and then practically the two main types of dividend investing. So first up, what is a dividend? And I love this summary here. It is as simple as it can get. A dividend is a portion of a company's profits that is paid out to its shareholders. When a company accumulates retained earning, management can choose to reinvest in the business to fuel growth, pay off debts, or save for future needs. Alternatively, management can decide to share some of these profits with shareholders. This profit sharing is called a dividend. In other words, a business does its normal thing. It sells products or service, gets revenue, and then shares part of that revenue with you if it chooses to. And then, of course, why do people invest in dividends? You hear a lot of people going for dividends here and there, so why do they do it? Dividends are an essential part of many investor strategy, especially those who are looking for a steady income stream from their investments. Companies, mutual funds, and exchange-traded funds that pay regular dividends are often seen as stable and profitable, making them attractive to investors who prefer lower risk opportunities. In other words, dividends are basically used by investors for a stream of passive income. They make an investment, and then once they make that investment, they don't have to do anything to earn this money. And this, of course, is something that I do. Now, here is a real screen grab from my portfolio dividend history. And every green number you see here is a dividend that I earn. Now, I earn dividends monthly and also quarterly. I have the JP Morgan Equity Premium Income ETF, which is an extremely popular ETF for income, and that pays monthly, whereas an ETF like Schwab, the US Dividend Equity ETF, which is another extremely popular dividend ETF, pays quarterly, and as does the Vanguard Dividend Appreciation ETF. So these dividends are money that I earn without having to lift a finger. I don't have to work for it. I just simply invested my money at some point, and now the ETFs are paying me my due share in dividends. Now, a huge thing in the dividend investing community is something called DRIP, or a dividend reinvestment program. This is simply using that dividend and automatically buying new shares of dividend stocks or ETFs for more shares. So the strategy allows investors to compound their returns over time by accumulating more shares, which themselves pay dividends that will be reinvested. So going back to the snapshot of my portfolio, you do see this in here as well. You see a dividend reinvestment. So for example, the Vanguard Dividend Appreciation ETF on December 26, 2024 paid me $225. But then you see immediately after a buy of $200.25 going into that ETF, which bought me approximately 1.01 shares. So that is dividend reinvestment. So in other words, my passively earned dividend income is buying me more shares of this ETF, which will then in turn make me more dividend income in the future. Now, this is called DRIP. A lot of people also call this the dividend snowball method. Either way, just think of it as getting more money in the future by reinvesting that dividend and continually allow that dividend to compound. All right, so key terms when it comes to dividend investing that you'll hear. You'll hear the most popular term, which is dividend yield. Now, dividend yield is simply the amount of money a company pays shareholders for owning a share of its stock divided by its current stock price. Now, this is very simple. So the dividend yield of SCHD is 3.8%, and the annual dividend right now is $1.06 approximately. So the dividend yield is computed from taking that annual dividend that they pay you and simply dividing it by the current share price. So in other words, for every dollar that you invest in SCHD, you're going to be getting every single year right now a dividend yield or a payment back of 3.8%, and every stock or ETF that pays a dividend will have a dividend yield. So I am using Coca-Cola as an example here, extremely popular dividend company. The current dividend yield of Coca-Cola is 3.12%, and the annual dividend is $1.94. So if we took that $1.94 and then divide it by the current share price of Coca-Cola, you would come up with that dividend yield. In other words, similar to SCHD, every dollar that you invest into Coca-Cola will yield you back annually 3.12%. Another extremely important number when it comes to dividend investing is the dividend growth rate, and that is simply the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. And the most simple way to illustrate this is to simply look at a history of dividends. So I am back to using SCHD as an example. Now, when SCHD first started paying its dividend, it was paying in the 12 to 21 cent range. But if you notice, this dividend in its cash payment column slowly increased over time, and now in 2024, it is paying a much higher dividend. Discount this because SCHD undergone a share split which modified its dividend payout. But you definitely do see prior to that, it increased its dividend substantially from the teens to low 20s to the 80 to 70 cent range. Now, of course, dividend growth can be illustrated as a percentage. So SCHD, for example, grew its dividends by about 11.6% on average for the past 5 years. Now, that is great dividend growth, and that just goes to show how much a company can grow its dividends year over year. So every year on your money, you're going to be getting paid 11.6% more. And that brings us into dividend yield investing and dividend growth investing. So that's why I told you about those two different ratios prior. There's basically two main types of dividend investing. You can invest for dividend yield and also dividend growth. Now, SCHD is more seen as a dividend growth investment. It grows its dividend substantially year over year, but it doesn't pay too high of a dividend at 3.8%. Now, on the other hand, you have high yield dividend ETFs like the Invesco High Yield Equity Dividend Achievers ETF, PEY. It offers a dividend yield of 4.6% currently, which is a bit higher than SCHD. But if you look at the dividend growth rate of this ETF, it is only around 6%. So SCHD's annual dividend growth rate significantly beats out the higher yield ETF. Now, in short, what this means is that if your time horizon is longer, you probably want an ETF like SCHD that offers a high dividend growth rate. Now, if your investment horizon is short term or you need income now, it might be wise to go for a high yield ETF, and that will, of course, limit your dividend growth, but you are going to make up for that with getting more money right now. A little about companies that pay dividends. So when you are going to get a dividend, you are generally going to be receiving them from mature companies. So think Coca-Cola, think AT&T, think Verizon, think any large mature company. Now, these companies don't necessarily need to not be growing. There are plenty of companies that are dividend growth companies that are still in their growth phase, that are dividend growth companies. But typically, you're going to be seeing dividend payers in the growing, late growing stage or maturity phase. You're not really going to see any dividend companies that are still early in their growth phase. And that simply is because, like we said before, dividends have a purpose of paying out shareholders a portion of their profits. And when you are in the growth phase, most companies want to reinvest those profits for more growth. So think of AT&T, a very popular dividend company. Its market share is pretty much at its max. So AT&T chooses to, instead of reinvest in the company, to pay those shareholders a dividend instead. And finally, you will be paying taxes on your dividends if they are not held in a tax-advantaged account. And I'm not going to get too much into how much you're going to be paying in dividends, because the main point is a qualified dividend and also an ordinary dividend. Now, qualified dividends, you're going to be paying a different rate than ordinary dividends. Most people would want to hold a qualified dividend because the tax rate is far more favorable. Now, on an ordinary dividend, you generally are going to be paying your income tax bracket, whatever that is, on those dividends that you receive. And that is dividend investing, as simple as it gets. And I know a lot of people out there, again, are still going to want more information, But I hope I gave you some of the necessary basics to go out and do even more research, or at least get started in investing in dividends. Please, if you did enjoy this content and you saw this content as helpful, give this video a like to get this content out there to a wider audience. And if you do enjoy this content, I do talk about investing, primarily dividend investing. So if you want to keep up to date on new content, please consider subscribing. It would be greatly appreciated, and I will see you all in the next video.